Professor Eichengreen is the George Pardee and Helen N. Pardee Professor of Economics and Professor of Political Science at the University of California at Berkeley, where he's taught since 1987. He's a fellow of the American Academy of Arts and Sciences, a research associate of the NDER. He's a research fellow at the Center for Economic Policy Research in London. He's been a senior policy advisor at the IMF. He's currently a chair of the academic advisory committee of the Peterson Institute for International Economics. Professor Eichengreen is also the immediate past president of the Economic History Association. He's received numerous awards, both for scholarship and teaching in economic history. 10 months ago, when we arranged Barry's visit, or certainly I, had no idea how topical this talk this evening would be. The current financial situation in Europe has dominated financial and economic news for several months now. It's been particularly acute over the last few weeks. It's now a daily news item that we all see. So Professor Eichengreen is ideally positioned to think through the current European sovereign debt crisis. He's been writing about related issues for decades. His 1992 book, Golden Fetters, concerned the gold standard in the Great Depression. His 2002 book, Financial Crises and What to Do About Them, seems prescient in its timing. His most recent book, published earlier this year, is titled Exorbitant Privilege, the Rise and Fall of the Dollar and the Future of the International Monetary System. His recent research and policy papers include the work on public debt, housing, international policy coordination, and so on. And Professor Eichengreen is also a frequent contributor to columns and op-ed pieces. In short, Professor Eichengreen is one of the world's foremost experts on the international monetary system and global finance. I cannot think of anyone better to discuss the current economic situation in Europe. Please join with me in welcoming our distinguished speaker, Professor Barry Eichengreen.
So thank you, George. Everyone can hear me? This is on. Thank you for the over-kind introduction, and thank you all for coming out on a wet evening. If you didn't come out on wet evenings, you'd have a very quiet life, I suppose. Anyway, it's good to see everyone here tonight. What I want to do is presentations like this, I think, are good for the speaker to try to figure out whether he really understands the events that are unfolding so rapidly around us. So what I'm going to do tonight really comes in three parts. How did we come to this point where Europe is engulfed in a gigantic financial crisis that is affecting American financial markets, the American economy as well, the global economy for that matter? Where we're now going, how we got here, where we are now, and where we're going. So there is a conventional narrative about the origins of the European crisis, that Southern Europeans are spendthrift. They live beyond their means. And there's an accurate narrative. Southern Europeans are spendthrift. They live beyond their means. But they're not all spendthrift in the same way, and importantly, someone lent them all that money, and that's a critical part of the story as well. So I have a couple of ways that we can try to understand the origins or the genesis of the crisis. So with help, let me show you the first.
On Thursday, Greek Prime Minister George Papandreou reversed his decision to hold a referendum crisis. It sounds complicated, but I'll explain it in a closer look at Europe. It's actually very simple. Europe said to Greece, we will give you the money you need, but you have to change your ways. But the Greeks are not good at changing their ways. They've had the same coffee cup design for 5,000 years. But it's too easy to just blame the Greeks. I also want to blame everyone who thought lending the Greeks money was a good idea. You don't even have to go to Europe to see that Greeks are bad with money. Just go to a Greek diner here in New York. 2 people eating, 14 people working, and you can get a turkey sandwich the size of a dictionary for $3. It's not a solid business plan. What do you expect from a country whose main export is doctor's office paintings? It's a yogurt-based economy. The only thing that works together in Greece is eyebrows. With that said, I love following the Euro debt crisis because, with all due respect to Brangelina, the most interesting couple on earth is these two. German Chancellor Angela Merkel and French President Nicolas Sarkozy. How great is this pairing? They could look more like a German woman and a French man if they were cartoons in a Tintin book. It's up to these two to hold Europe together, and you're not getting any help at all. The leader of the next biggest country in the Eurozone is Italian Prime Minister Silvio Berlusconi, who is going on trial for having sex with hookers. So basically, Berlusconi's best economic plan is the money's on the dresser. 2 weeks ago, Slovakia said, hey, we're not sure about the bailout. Europe said, why do we care about what you think, Slovakia? Slovakia said, because we're in the Euro, and all the votes have to be unanimous. Unanimous! 17 countries and it has to be unanimous. I can't get 3 friends to agree on a restaurant. So imagine how hard it would be if none of us spoke the same language and our grandparents killed each other in World War II. Why do you ever think you can get on the same page in Europe? You guys have shared the Italian continent for 2,000 years and you still don't speak the same language. Belgium has 2 languages and it's the size of a Midwestern college campus. So hold on for these 2 crazy kids right here. Germany and France, Germans. If romance is 2 people love, Germans is 2 people staying together for their kids. I don't think it's going to work out, but I like that they're trying.
This has been close that.
So that's the entertaining part. The humorous but vaguely sober part. One way of understanding the crisis. Here then is another. Here's an economist's way of understanding it. So where did this crisis in Europe come from? It came from some of the unintended or unexpected financial consequences of the creation of the euro and the adoption of a single European currency by first 12 and now 17 European countries, starting in 1999. So in 1999, indeed before that, different European countries were regarded as more or less risky, depending. They had very different borrowing costs depending on the state of their economy, what people thought their inflation rate was likely to be, what people thought their economic and financial prospects were. With the creation of the euro, countries that had previously had very high borrowing costs, read Greece in orange at the top, although you can see that the phenomenon was more general, found themselves able to borrow at the same low rates of interest as, for example, rock-solid Germany. So it's not clear why this should have been the case, why people were so willing to lend so freely at such low interest rates to the Greek government, but they were, and they were willing to lend to governments and households and companies across southern Europe at low German interest rates. Someone evidently believed in the convergence theory, the idea that the poor economies of southern Europe that started out behind would grow rapidly and their levels of income would converge to those in Germany and more generally the northern European core. So the lower cost of borrowing that I showed you in the previous slide encouraged, in effect, a big party across Southern Europe. It was easy to borrow at a low interest rate, and the result of that was more spending and less saving across Southern Europe. You see that in the case of Spain, Greece, and Portugal, and the honorary member of Southern Europe, Ireland, in green. You don't see it in Germany, of course. You see the opposite, the thrifty Germans saving even more as the decade progressed. So to repeat, someone had to lend the Southern Europeans all that money. And you can see from the yellow line at the top who that was. It wasn't all or even mainly the government. So people talk about the European debt crisis now as a sovereign or government debt crisis. A large part of the fiesta was in the private sector. There was a boom after 1999 in private real consumption spending in Ireland and Greece and Spain, in Portugal. They borrowed from Germany and more broadly externally in order to spend, and you can see the Germans again behaving very differently at the bottom of this figure. But it wasn't all consumption. There was also a lot of investment spending. Not all of that investment was productive, so a lot of the investment was, like in the United States before 2007, in residential real estate, in Spain and in Ireland. In particular, we know with benefit of hindsight that not all that in investment was productive. And firms in these countries, for their part, could pass through higher production costs because domestic spending and domestic demand for what they were producing was so strong. So you see here a measure of labor costs. The cost of producing 1 unit of output in manufacturing going up in Greece, going up in Portugal, going up in Spain, not in Germany, and interestingly, not in Ireland. So this is a first indication that Ireland is kind of a special case where they indulged big time in one of the excesses of the last decade, namely they had a big housing boom, but some of the other problems that developed across Southern Europe, that costs spiraled out of control, productivity failed to keep up, that was not part of Ireland's problem. And that divergence in the cost of production between Northern Europe and Southern Europe in turn made for a divergence in competitiveness. So the countries whose costs were going up had to mark up the prices of what they produced and sold. Their exports stagnated. You can see that at the bottom of the figure, while once again, behavior in Germany was quite different. And once again, Ireland looks like something of a special case. So it is tempting on this basis to blame those spendthrift Southern Europeans who failed to save over the course of the last decade. But again, when you look at the whole figure, you're reminded it takes two to tango. Someone had to lend them all that money, and you can see from the yellow line who in large part it was. With hindsight, then, the story is clear. There was the false belief, starting in 1999, that monetary union guaranteed fast growth in the euro area periphery, Southern Europe and Ireland. It eliminated sovereign risk, which means the risk that a government will default on its debts, and that the elimination of sovereign risk and the expectation of fast growth in the euro area periphery encouraged reckless lending to these countries. The same belief in the euro area periphery itself led to reckless spending. The result was over-leveraged banks at the center, which means France and Germany, and a loss of competitiveness at the periphery. And then Europe had the bad luck that it was battered by a global financial crisis that originated in the United States with problems in the subprime market and the derivatives markets and so forth The European expectation was that they could proceed with monetary union, and then over a period of time, they could build a European treasury. They could move to fiscal union as well as monetary union. They could move to political union so that these new institutions would be held properly accountable, that they would perhaps have 20 or 30 years to complete the process. All of that was profoundly derailed by the crisis they experienced starting in 2008 that widened their government budget deficits, that vastly increased their debt burdens, that damaged their prospects for economic growth, and that, of course, left no time to complete the process. So where we are now, this part of the talk basically comes in one slide. We're in a situation where the interest rates that European governments have to pay investors in order to issue debt to finance their ongoing budget deficits have exploded. So this figure is a couple of weeks old, and it is way out of date. These spreads continue to rocket upward in a way that creates real doubts about the solvency of not only the Greek government, but the governments of Portugal, Ireland, and Spain, and, of course, the government of Italy. So Greece is about 2% of the euro area economy. It accounts for 2% of the GDP of the combined 17 countries that have the euro. Italy is about 18% of the euro area economy. So Italy is the big cannoli. What is happening in Greece is a disaster, especially a disaster for the Greek people, but it's a disaster that the rest of Europe can, in principle, be fenced off from. In principle, yes. In practice, perhaps. But Italy is so big, so important to Europe, so connected to the rest of the European economy that there's no way it can be fenced off. So the yield on 10-year government bonds in Italy is now on the order of 7%, with a 3% nominal rate of growth of income in Italy, and a debt-to-GDP ratio well above 1. The debt-to-GDP ratio in Italy is 120%. There's no way that this arithmetic can add up. They have to pay way more on their debt than they can afford because the debt burden grows faster than the economy. It's a big national Ponzi scheme if the nominal interest rate so exceeds the nominal rate of growth of the economy. So you can square that circle in principle by reducing the debt burden, by not issuing more and retiring some of the debt that's outstanding. So if Italy runs a budget surplus, net of interest payments, of 4 to 5% a year, it can retire debt fast enough to remain solvent. But it's not clear that politically Italy, or for that matter, any country can move from what have until very recently been substantial budget deficits to a very large surplus. Think of all the public programs you would have to cut, whether Italy can do that overnight. And Italy is the third largest economy in the Eurozone, is too big to fail, but it could also be too big to save. It's not clear that the institutions of the European Union have the capacity to prevent Italy from lapsing into default, and I'll come back to that in a few minutes. So all of this begs the question of why now? I told you a story in the first few slides of a process that unfolded over the course of a decade, starting in 1999, and then big problems that began to develop starting in 2008. But here we are in the late months of 2011. Why now rather than last year or the year before, or for that matter, next year? So when I ask myself that question, I think about a variety of technical factors at play. So bunga bunga is one of Berlusconi's favorite phrases. He became increasingly incapable of governing his country. The European crisis is now first and foremost an Italian crisis. He was unwilling to push through painful measures of austerity and adjustment and get Italy back on the track toward insolvency because, as we saw in the video before, he had other things on his mind. That could have been the problem. There was a decision in October that at some level was wise. Part of the problem in Europe is that the banks are weak and they weren't force-fed new capital in the same way U.S. banks were after 2008. So if Greek debt is restructured, as it will be, banks in Europe hold a lot of those Greek bonds. They will suffer losses and people will worry about the stability of the banks. You have to bulletproof the banks against those problems by requiring them to raise more capital. So this fact was acknowledged in October, which was a good thing, but there wasn't a decision made to force feed the banks capital, to inject public funds into the banks. Rather, politicians in Europe told the banks, you can increase your capital adequacy ratio any way you want. What does capital adequacy ratio mean? It means how adequate is your capital relative to your assets, to your investments. How high is the ratio of your own funds, your liquid funds, relative to your loans and investments in bonds, some of which may go bad. You need an adequate cushion against losses on those investments. So one way to increase your capital to asset ratio is by raising more capital, issuing more public equity, if you can find anybody to buy it. So that's why Chinese banks and others have been sniffing around Europe recently. The other problem with that, besides who's going to invest in European banks at the moment, is that this dilutes the existing shareholders. People who hold stock in those European banks are going to have to share the profits with the new stockholders if the banks raise capital by issuing additional shares. So they don't want to do that. How do they raise their capital to asset ratio if they don't want to issue more capital? They run down the assets, right? They stop lending, or they sell off the Southern European bonds that they already have in their portfolios. So that could have been another factor that brought the crisis to a head. Now, finally, banks and others in Europe thought that they could buy insurance on their bonds, credit default swaps, in other words. And the way that the restructuring has been done in Greece is expressly designed not to trigger those credit default swaps, not to cause them to pay out. So an end run was done around the insurance policy. European bonds have been revealed to be riskier than people understood previously. That could be another reason why there is a sell-off in the market and yields on these bonds are spiking. A fourth technical factor could be panic, that investors sell because other people sell, and we could be in one of those periods now. My own view is that there are good fundamental reasons why the crisis has grown more severe at this point in time, which is that the European economy has stopped growing. That we know that economic conditions are tough across the advanced economies. Across Europe, governments are engaged in austerity measures. They're cutting public spending and in some cases raising taxes. Growth is grinding to a halt. And if you can't grow the denominator of the debt to GDP ratio, you have to shrink the numerator, and that's very, very hard to do. Investors realize that, and that's why I think the markets have reacted as they have. So what to do? There are a number of alternatives on the table. None of them are very attractive. There's an alphabet soup now of alternatives. So there was Plan A, which was austerity. If these governments can only balance their budgets, stop issuing more debt, and even better, move their budgets into surplus and retire some of the excessive debt that they have injected into the market, everything will calm down and everything will be well. Plan B is debt restructuring, maybe it won't be possible to pay off these debts after all, and in some cases like that of Greece, the debt will have to be written down to 79 cents on the euro. They have cents as well, or 50 cents on the euro, or 10 cents on the euro. Time will tell. Plan C would be break up the monetary union. Part of the problem for Greece is that it can't restore its competitiveness by devaluing its own currency. It doesn't have its own currency. So adopting the euro in 2001 was a mistake for Greece. The argument would go, why not roll the clock back and solve the problem in that way? Plan D is a quantum leap in European integration, move to a European federation. And in that way, the continent can solve all its problems. And Plan E is that the European Central Bank needs to step in. So what I want to do now is to walk through these 5 options and give you at least my sense of how I think things are going to play out. So Plan A is, as I explained, austerity. It's to rely on government spending cuts and tax increases to bring down the burden of indebtedness. So governments are increasing the retirement age to reduce expected future government spending on pensions. The Italians have been brave and committed to increasing the retirement age by 2 years, by 2025. This strategy relies on privatization of public enterprises, of telecommunications companies and the Postal Service and others to boost revenues one time, and more generally to eliminate soft budget constraints, to eliminate a situation where the post office runs a deficit and the government has to step in again and again and give it more revenues. Part of this is the adoption of balanced budget rules at the national level where they don't exist. They call them debt breaks in Europe as a way of credibly restraining future spending. Labor and product market reforms and reductions in labor costs to enhance competitiveness, restore competitiveness and boost growth, and more generally, stronger oversight at the level of the European Union by the EU's proto-executive branch, the European Commission, not just of national fiscal policies, something which they ostensibly have in place at the moment, but also more effective oversight of other policies affecting growth and competitiveness at the national level. So that sounds admirable and it seems to make sense. What are the problems with Plan A? We know by now government spending cuts and tax increases only depress growth in the short run, which only depresses government revenues and widens the budget deficit. The whole purpose of this exercise being to narrow the budget deficit. Privatization is politically difficult and time-consuming. It doesn't help very much in the short run, and the crisis at the moment is all about the short run. Pro-growth reforms, like making it easier to lay off redundant workers, are likely to only depress growth in the short run. What's their immediate effect? Firms lay off redundant workers who don't have a paycheck and they don't spend. So even if these policies will enhance labor market flexibility and economic flexibility in the long run, they have perverse effects in the short run. Deep recessions lead to political backlash and threaten to topple the governments implementing the austerity measures. And markets look forward to this possibility. They see the writing on the wall, so interest rates go up rather than down, and debt burdens go up rather than down as a result of these austerity measures. So you've got to do something else, and that leads to Plan B, which was first tabled really last summer, which is to add to austerity the restructuring of debts where they are no longer viable, where there is no prospect that through austerity alone they can be repaid. So the idea is to write down the government debt of Greece on a voluntary basis. The old plan was the headline figure was 21%. The new plan, the headline figure is 50%. And with this concession, the government doesn't have to raise taxes simply to pay the bondholders. With this kind of debt relief, the country's debt to GDP ratio will fall to what is supposed to be a more manageable level of 120%, pause, by 2020. So problems with Plan B, you'll see the illustration is pretty similar to the illustration that accompanied Plan A. A 50% reduction, technical term for a reduction on the burden of the debt is a haircut. On only that 2/3 of the debt held by private investors, a third of the debt is now held is owed to the International Monetary Fund or to Greece's European Union partners. A 50% haircut on 2/3 of the debt is in fact only a 33% debt reduction. Much of that debt is in fact held by domestic Greek banks, all of which are going to be bankrupted if the debt is written down significantly. They're going to have to be stabilized. More public funds are going to have to be injected into those banks so they can reopen their doors. Where is that money going to come from? 120% of GDP is not, in fact, manageable for an economy that may not start to grow again for another 3 years, even according to the International Monetary Fund. Even bigger, I don't know if the right word for haircuts, even more severe haircuts on Greek debt, which will be coming, will mean bigger losses for French and German banks, which are already being asked to raise on the order of 100 billion euros worth of new capital to prepare themselves for losses on their holdings of Greek debt. So what's the idea here? Is the idea that Portugal, Spain, Ireland, and Italy should also adopt Plan B? They should also restructure their debt in this way? What would that mean for the European banking system? What would that mean for the U.S. banking system? U.S. bank shares have plummeted in the last couple of weeks, you may have noticed. That has more than a little bit to do with what's going on in Europe at the moment. So that leads people to say we have to add to the mix, to the austerity which is unavoidable in countries like Greece that have been living vastly beyond their means. And we have to add to the debt restructuring, which is unavoidable given that some of these countries are insolvent. We have to give them back their own currencies. They have to exit from the euro area. Greece, for example, would reintroduce the drachma, and then it would lower the value of the drachma against the euro. So a very prominent German economist in Munich, Hans-Werner Sinn, has said the Greek economy is not very different from the Turkish economy. This has not made Mr. Sinn very popular in Athens. So he says we need to lower Greek costs to Turkish levels. That could be accomplished by depreciating the new drachma against the euro by 44%. That would make Greek exports of olive oil and feta and wine and other things more competitive on international markets. It would make Greek islands much more attractive and economical as tourist resorts. The Greek economy could begin to grow again on the basis of these exports of merchandise and services. The unemployment rate would begin to come down. The political backlash against the policies of austerity would begin to die down, and with growth, social stability would return, financial solvency would return. So it seems pretty straightforward that part of the solution here ought to be the crisis countries exiting from the euro area. So problems with Plan C. Here I cannot resist a personal note. In early 2007, I was asked by a couple of European colleagues to write a paper for a conference and a volume. So you can see the volume here, Europe and the Euro. It was called University of Chicago Press 2010. Publication lags in academia are very long, but I wrote this article in 2007, and they asked me to write about the breakup of the euro area before the subprime crisis in the United States, before troubles in Europe. I sat back and thought about what the consequences of a country like Greece leaving the euro area might be. And I concluded it would be an unmitigated disaster, and therefore it would not happen. So rarely do academics have the privilege of a real-time test of their theories, which I certainly have here. So what did I argue in that article? I argued that reintroducing your national currency when you're part of a monetary union is not exactly straightforward. To start with, this would be a policy decision that would have to be taken by the Greek parliament. We've seen a lot of the Greek parliament in the last couple of weeks. Greece is arguably the world's oldest democracy. There would be a parliamentary debate, and it would be televised, of course. So you're a student in Greece, or you're a worker in Greece, and you hear that your parliament is debating the possibility of reintroducing the drachma and converting your wages and savings from euros to drachmas with the express purpose of reducing their value by 44% relative to their prior value in euros. So what would you do on the first minute you heard that this possibility was even being remotely contemplated? Answer is clear. You'd wire all your money to Frankfurt. So this would be the most extreme banking panic and banking crisis the world has ever seen. I think the phrase I used in this article in 2007 was, this would be the mother of all financial crises. So all the money would be withdrawn from Greek banks in the first minute. The banks would close. Foreign lenders to Greek businesses would cancel their credit lines for fear that they would only get 56% of their money back after the drachma was reintroduced and depreciated against the euro. The stock market would close. The bond market would close. Capital controls on your ability to get money, your euro banknotes, out of the country would be imposed, and border patrols would be dispatched to enforce them. There would be a crisis of confidence in the new drachma, which would plunge against the euro. Inflation would soar as people rushed to the stores to get rid of their new drachmas and to buy cans of soup instead. Legal disputes would erupt. For example, is a German bank's loan to the Greek subsidiary of BMW now still a loan denominated in euros, or is this loan now denominated in new drachma, where the subsidiary can pay back the bank in Frankfurt in drachma rather than euros? So these questions would be adjudicated. That's the polite way of saying they would be tied up in courts for years, and your favorite judge would get to decide whether he wanted to bankrupt the Greek subsidiary by keeping the obligation in euros, or bankrupt the German financial institution by allowing them to be converted into new drachma. Parenthetically, again, I've asked some of my European friends, whose courts exactly would decide in a case like this? And the answer is, it depends whether it's an affiliate or a subsidiary. Is it going to be a German court or a Greek court? It would be messy. Banks in other countries with exposure to Greece that had lent money to Greece or bought Greek government bonds would then, questions would be asked about their stability. No one would lend to them. They would be locked out of the market where they borrow overnight from other banks, which is an important way that banks square their balance sheets on a day-to-day basis. Since no one would be sure who was solvent and who was insolvent financially, the entire interbank market would seize up. Bank lending across the European Union would cease. Economic activity would be halted. And then there would be the contagion that the problem that people would say, well, if Greece is talking about this today, Portugal is going to talk about it tomorrow, and Spain the day after tomorrow, and Italy the day after that. Where would it stop? So you may think I exaggerate when I tell this story. To some people, they think I exaggerate? I don't think so. I think Lehman Brothers was disruptive. This would be Lehman Brothers squared. So that's what I concluded in my article in 2007 was that the short-run economic costs would be so great, the financial calamity would be so disruptive that European leaders would not allow this to happen. They would do whatever it took to prevent this kind of catastrophe from occurring. So I continue to believe that that's what rational politicians and economic policymakers would do. They would see how catastrophic the collapse of the euro area or even the unilateral exit of one country from the euro would be, and they would do whatever it took to prevent that. What I've been reminded of, and you all knew, of course, but an economist forgot, was that politicians don't always opt rationally for the lowest cost option. Unexpected things can happen, and all I can say about that is if this kind of unexpected thing happens, batten down the hatches. Germany is a different case, of course. Germany is the one country that could, in principle, exit from the euro area and reintroduce its own currency without experiencing this kind of financial crisis. Everybody would expect that the new Deutschmark would strengthen against the euro because Germany is has a strong economy and solid finances. Everybody would move their money into the German stock market and into German banks in the expectation of making money rather than the opposite. There's considerable disenchantment about the euro in Germany, and if not a new Deutschmark, what about a new Northern European euro instead, in which Germany and the Netherlands and I guess at this point in time that would be about it, Finland, exit the euro area together and introduce a new Northern European mark. So there was a scandalous story last week on Reuters that said actually some of the Europeans had been talking about this. I say scandalous because it was apparently untrue. Problems with that variant of Plan C. Germany exiting from the euro area and people expecting that the rump euro, what was left, would then fall apart, would create all the same chaos in Greece, in Portugal, in Spain, in Italy as the other scenario that I described to you. Could Germany prosper while the rest of Europe was in a crisis? German exports would presumably collapse as the new Deutschmark soared against the euro. So I show you a Swiss franc here because this is the problem that Switzerland as a safe haven currency has been experiencing until very, very recently. Would the collapse of the euro mean the collapse of the European Union and the broader project of economic and political integration that has been underway in Europe ever since World War II? So this is Berlin in 1945 at the bottom. The idea of European integration is really central, I would argue, to German political culture and regaining monetary autonomy in their own currency at the price of destroying the European project, I continue to believe is too high a price for European leaders to contemplate. So people have said repeatedly, Mrs. Merkel is a different kind of German chancellor than her predecessor. She grew up in the old East Germany. She was schooled differently. She wasn't schooled to believe that European integration is of the highest value. I think that reading of her motives and of German political culture is wrong, that she does believe that, and Germans more broadly attach a very, very high value to keeping the larger European project going. So that brings us to Plan D, which is moving forward to much deeper European integration, creating a European federation, if you will. So I show you here this French technocrat from the 1950s, Jean Monnet, sometimes referred to as the father of European integration. So one of the statements that he's known for So his point is when there is a crisis, where there is a critical decision of whether to go back to nationalism, to go forward to deep integration at every point in time until now on forward. If history is a guide, it may go forward again. What would going forward mean in this context? It would mean that European countries collectively assume responsibility for their government debts. So they convert Italian government bonds and urge Greek government to remain after the restructuring and Spanish government bonds and government bonds into Euro bonds, the equivalent of U.S. Treasury bonds. Then their respective governments, each of them individually and jointly responsibility for that entire debt. Quantum leap in European integration would involve creating a system of fiscal federalism like we have in the United States, where tax revenues are transferred in the U.S. via Washington, D.C., from booming states, which pay more taxes, to depressed states, which don't, a form of insurance against the kind of Southern European problem, booming Northern Europe, depressed Southern Europe problem that they have at the moment. A quantum leap in European integration would mean regulating European banks at the level of the European Union. So part of the reason Europe got into this problem is that French bank regulators didn't care a whit what the behavior of French banks implied for the Greek economy. So if French banks wanted to lend a bunch of money to Greece, if French regulators thought that was good for the French banks, they didn't care what it meant for the Greek economy. So those kind of effects, externalities would be the technical term, can be internalized, can be taken care of by shifting regulation up to the level of the European Union. And ultimately, if you're going to have a powerful bank regulator at the level of the EU, if you're going to have a European treasury to undertake these fiscal transfers at the level of the EU, if you're going to have Eurobonds, you need a European political system to hold those powerful entities accountable. You need a political union to hold them accountable and to make the key decisions at the level of the monetary union. So what are the problems with Plan D? Germans think of themselves as Germans, not as Europeans. We're all Americans, right? We don't think about ourselves to a first approximation, I write here, as Oregonians or Californians. We think of ourselves as Americans. We're all in this together, and if we have an economic crisis, we're all going to dig deep. There's powerful resistance to that idea within Europe. Germans view the crisis as a morality play, this same morality play of Southern Europeans who are irresponsible and can't live within their means. And why should we be in a fiscal union and a political union with those guys? And even if there were to be agreement on the principle of adding fiscal union and political union to the monetary union, it would take many years. It would take 27 countries, some in some of which the national parliament would have to ratify all the relevant legal changes, and others, like the UK, there would be a referendum on ratification to make it happen. And it would take years. It'll take decades rather than the period of weeks or months Europe has to resolve the crisis. So that leaves Plan E, which is the two Marios. Mario Draghi, the MIT economist, who's the head of the European Central Bank at the top, and Mario Monti, the new prime minister in Italy, the Yale economist, at the bottom. So how would Plan E work? It would start with the European Central Bank giving countries time to get their houses in order. So the European Central Bank, let me focus on Italy as an example, although the point is more general. The European Central Bank would buy Italian bonds big time through an existing facility, its so-called security market program. it can push Italian bond prices up to any level it wants if it buys enough of them. And by pushing the prices up, it pushes the yields down. That gives the Italian government some breathing space where its finances are not continually deteriorating. And Mario number 2 at the bottom uses that breathing space to get agreement on pro-growth reforms, labor market reforms, product market reforms, privatization, pension reform, and so forth, all the things needed to eventually get the Italian economy growing again. The markets are reassured, and if the markets are reassured, they're going to be willing to buy Italian debt again at lower interest rates. At this point, the European Central Bank can stop buying Italian bonds. It can exit the market. It can sell back into the market some of the bonds that it bought previously, and it can sell those bonds back into the market at a profit. It bought them when the prices were low. Today, once everybody is reassured that all is well, it can sell the bonds at a profit. None of this needs to be inflationary. None of it needs to damage the European Central Bank's balance sheet. None of it requires the German taxpayer to pony up more money to recapitalize the European Central Bank. In fact, the European Central Bank has been buying the bonds of Italy, Spain, Portugal, and Ireland at an accelerating rate. And you can see the greatly accelerating rate starting in August, the latest phase of the crisis. Here, that hasn't added anything noticeable to European inflation because the European money supply hasn't grown. When the European Central Bank has bought Italian bonds, it's with cash, it's neutralized the effect of that. It's sterilized its purchases by selling German bonds from its portfolio. So there's been no increase in European money supply. There's been no inflation. I would ask parenthetically, I shall return to this, would a little bit of inflation be such a bad thing for Europe under present circumstances? But the problem here is that the European Central Bank only has so many AAA-rated bonds, so many German and Dutch and Finnish government bonds in its closet, and it will run out of bonds to sell back into the market. It'll no longer be able to sterilize its bond purchases come the new year. And then the question becomes, what will the European Central Bank do? Will it stop supporting peripheral European bond markets? Well, maybe not. So, the securities sterilized bond purchases were supposed to be the European Central Bank's bazooka. Maybe it also has heavier artillery, which is quantitative easing. It can buy these bonds without sterilizing the impact on the money supply. Nothing in its statute prevents it from doing so. The European Central Bank, in fact, stepped into the market big time yesterday and bought, it is said by people who are supposed to know, something like 2 billion euros worth of Italian and Spanish bonds in one day, which, by the standard of this figure, it's bought about 180 billions worth over a period of months. That's pretty significant. And it was able to bring Italian spreads down at least temporarily. So maybe that's what the European Central Bank is going to do now. Buy the bonds of the troubled countries big time without sterilizing the impact on the money supply and give those governments the breathing space they need to put the relevant reforms in place. All of this, of course, is strongly resisted in Germany because in Germany the belief is inflation is always just around the corner. So the German newspapers, which I read when I have the stomach, are always talking about this episode at the top, the hyperinflation in 1922, when people had to take wheelbarrows full of currency down to the store in order to buy groceries. So French and German leaders are now visibly fighting about what the European Central Bank should do. The crisis has arrived on France's doorstep, and the French finance minister of Finances and Economy, says the European Central Bank needs to ramp up its support for the troubled economies. And the head of the German Bundesbank says, absolutely not, because inflation is just around the corner. And this is at risk of getting out of hand. So the French-German alliance has been at the center of the European project. Mrs. Merkel and Mr. Sarkozy have been the key players in trying to bring it under control. If they're now about to openly start fighting about this question, what's going to happen next? So there are a couple of more questions I want to ask about this, and then I will stop. Is it already too late for this kind of intervention by the European Central Bank to help? So European government bonds were supposed to be safe, and a lot of the demand for them was by conservative investors like pension funds and insurance companies, which liked them because the maturity and risk characteristics of those government bonds matched the maturity and risk characteristics of the company's own liabilities. They like 10-year government bonds because they look forward to paying out on a term insurance policy in 10 years. And they like the fact that values were relatively stable. Now they've learned that these bonds are not safe, secure, and stable. So is the private demand now gone away, never to come back? Has the European bond market been structurally damaged? The European Central Bank has in fact purchased already 20% of all Irish and Portuguese debt. And the interest rates that these countries have to pay are still elevated, still on the order of 6 or 7%. I think myself, technically nothing prevents the European Central Bank from buying more and more and more and pushing the prices of those bonds up and the interest rates on them down to desired levels. Other people worry a lot about the side effects. They worry about the damage to the European Central Bank's balance sheet if governments ultimately go bust. They worry about what economists refer to as moral hazard for national governments. If the European Central Bank helps Italy by pushing Italy's borrowing costs back down toward German levels, doesn't that just take the pressure off the Italian political class and the politicians to take painful measures? Italian politicians, the argument in Berlin goes, in Frankfurt goes, will only agree to painful measures when their backs are to the wall. And for the European Central Bank to allow them to exhale would be exactly the wrong thing to do under present circumstances. So that's why we had this really bizarre and politically uncomfortable situation last month where the outgoing president of the European Central Bank, Jean-Claude Trichet on the right at the top, and the not yet in office new president of the European Central Bank, Mario Draghi, on the left, jointly wrote a letter that they sent to the Spanish and Italian governments, basically giving them their marching orders, saying you need to do this, 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 and this, and you need to do it quickly if you want support from the European Central Bank. So that's really an uncomfortable situation, right? These technocrats, independent technocrats, writing letters demanding painful economic reforms of governments. I write here that would be a little bit like Mr. Bernanke telling the Super Committee to balance the budget or else, and specifying exactly what combination of revenue enhancement and spending cuts the Super Committee had to undertake to get his support. So I do think there is another way. Europe has created an emergency rescue mechanism, the European Financial Stability Facility. It is called, with a little bit of capital, with the power to negotiate with governments and lend them money to help them out. The obvious solution here is to turn the EFSF into a bank, to give it a bank charter, let the ECB lend to it, and it can turn around and negotiate with the French. I meant Italian, but French is fine, with the Italian and other borrowing governments. That's what it was established in order to do. So how do I think this is all going to play out? He who relies on the crystal ball ends up eating ground glass. My best guess is that Europe will eventually proceed to Plan E, which means that the European Central Bank does what it takes to support the euro and drive borrowing costs back down to tolerable levels in the short run, and that Italy and other countries do the necessary in order to demonstrate their solvency and regain market confidence. I think that will ultimately happen because, as I argued before, the alternative is too dire for them, for us, and for the world to contemplate. But I think it will only occur after there has been more volatility and more chaos and more demonstrations of the very high costs that everyone would pay if they don't take these painful steps. There is the possibility, of course, that someone will miscalculate. So I argued before that it would be an economic catastrophe for Greece to abandon the euro. It might be able to enhance its export competitiveness and grow sometime in the future, but it would pay enormously high costs from doing that in the short run. And yet it's possible that a mistake could be made. They could have a referendum, they almost did, on whether to keep the euro or not. And we don't know how that referendum question is going to be framed. You have propositions on your state ballot here like we do in California, just not as many as we have in California. It all, you know, it all depends on how the question is framed. Do you want the euro? Or you can have the euro, or you can have the end of austerity, and we'll go back to free spending. Given that choice, every Greek would say, let's abandon the euro and let the good times roll, but that's not the choice for Greece. It's going to have to tighten its belt either way. So how the question is framed, what the politicians do in parliaments, is uncertain. And there could be, a mistake could be made. So will Greece leave the euro? If you'd asked me in 2007, actually the quote I gave a German newspaper, it was a bit more recently than that, was that the probability of a member leaving the euro area is equal to the probability of a meteor hitting the Euro Tower, the building in which the European Central Bank is housed in Frankfurt. So John Maynard Keynes was famous for, in a conversation, being accused of inconsistency. And his response was, when the facts change, I change my mind. What do you do, young man? I've had a reminder of that politicians can miscalculate, and that democracies, love their souls, sometimes produce unexpected outcomes. But I would still put the odds of Greece leaving the euro over the next 12 months at no more than 10%. So I'm not the only person who thinks about this. You can go to Intrade and put your money down on the odds of the likelihood of Greece leaving the euro. A country currently using the euro will announce their intention to drop it by midnight Eastern time, 31 December 2012. And you can see that the probability implied by the price of the contract is 46%. So I guess if I believe this, I haven't put any money down yet, but it's clear which of these contracts I should buy. So let me stop there. I have left many potential questions unanswered, and I'm happy to hear some of them.
So Professor Eichengreen has agreed to take some questions, so just go ahead and start.
Okay, this is in regards to Greece leaving the euro system. Why would Greece leaving, why would that lead to foreign banks pulling all their money out of Greece?
So the question was, why would foreign banks pull all their money out of Greece if they anticipated Greece would be leaving the euro? It's not only foreign banks.
We'll just anybody.
Why would anybody pull their money out of Greece? Because the express purpose of reintroducing the drachma is in order to use the drachma exchange rate to try to make Greek goods and services more competitive. So part of the problem that Greece is in is it doesn't export very much that other people want to buy, that its costs are too high, and that they have risen much faster than productivity has risen in Greece over the course of the last 10 years. Historically, countries have gotten into that bind from time to time. Latin American countries over the years have had populist governments that have won re-election by giving lots of goodies to the public. They end up with a problem of competitiveness, and that has to be fixed. So how can it be fixed? Really in two ways. One is by internal devaluation, which is that I agree to have my pay cut by 5% or 10%, or if you think like Hans Werner Sinn, 44%. But there are big problems to getting that done. I'll do it if everybody else does it. Do you agree to cut your pay by 44% at the same time I do? So there is kind of the equivalent of, it's like you can get everybody to get up an hour earlier is it an hour earlier or an hour later in the winter? Or you can go to daylight savings time and just set all the clocks back. You can jump down the exchange rate and reduce costs in terms of euros all at once, and you and I don't have to agree on anything. So that's the argument for, if you have a national currency and a competitiveness problem, devaluing your currency is a way of making your goods more competitive. And when people know that, they know what the intention is. Everybody knows why there is a discussion now about reintroducing the drachma. If your bank account is going to be worth 44% less in terms of euros tomorrow, well, let me move my bank account into a bank that will still be in the euro area tomorrow before it's too late. So that's basically the bank run story.
Why we should care here in the U.S. about the crisis in Europe?
So the question is, why should we care here in the U.S. about the crisis in Europe? The euro area is one of the three biggest economies in the world, along with the United States and China. They are one of our largest trading partners. More immediate, so if they descend into a recession, which is all but certain at this point, or worse yet, into a deep recession, which I think can still be headed off, that's going to be bad for U.S. firms, U.S. exporters who sell goods to Europe. More important than that, I think, is the financial linkages, that U.S. banks lend money to European banks. So U.S. banks proudly say, we don't hold much Greek paper. We don't have very many Greek or Italian bonds. But they lend money to BNP Paribas, which does own that stuff. So if BNP Paribas gets into trouble, Citigroup gets into trouble, Bank of America gets into trouble. I think those are the principal reasons. It seems to me very hard to imagine that even our current disappointing economic recovery could be maintained if Europe has a financial crisis and a deep recession.
You mentioned that a potential short-term solution through about mid-January would be for the European Central Bank to sell off more AAA bonds and pick up Italian debt to stabilize the situation, just to let markets sort themselves out. And then you also suggested that the European Central Bank, as the value of Italian debt rises, if it's stable again, might even be able to make a little bit of a profit from selling that back in. What makes you think that the markets would be so willing to go back to Italian debt and value it as anything more than what it is right now?
So could people at the top hear that? So it's a good question. My view is that what the European Central Bank would be engaging in is a holding action. It would be helping to finance European governments which are trying to narrow their budget deficits but can't eliminate enormous budget deficits overnight without, severely injuring their own economies, the European Central Bank can finance them at reasonable interest rates for a period of time. And then the governments in question have to demonstrate that they're ready to do the right thing and to put in place the painful but necessary policy reforms. And if the second thing happens also, then the markets would have reason to be reassured. And then the European Central Bank would make a profit on the operation. So that's why this is like a game of chicken. Another analogy would be mutually assured destruction, as a way of maintaining the peace during the Cold War, that the European Central Bank doesn't want to support the Italian government until the Italian government demonstrates its commitment to these painful reforms. But the Italian government can't demonstrate commitment to painful reforms all on one day. There's, the new cabinet in Italy was only named yesterday. It needs some time and breathing space. So there's a real problem here of getting the pieces to work together. I think the European Central Bank has to swallow hard and move first and take a risk. And I worry that the euro area won't survive if it doesn't. Am I confident that it will? I had that slide a moment ago. I think that it will do little in the short run. The situation will deteriorate further. People will grow more alarmed, and the European Central Bank will realize that it's got to take aggressive action. That's my best guess of how things will play out.
Yes, thank you, Professor, for your clarity. I have a question. Why can't the EU simply drop the value of the euro? Because when it was first introduced at 85 cents, there was a tip in employment, tourism. Now it's $1.43-ish. Their exports are dropping, tourism is dropping, and America's exports are increasing.
Well, so it's a very good question. I think I would frame it a little bit differently. Europe as a whole doesn't have an export problem, or the Eurozone as a whole doesn't have an export problem. Its trade is balanced. Southern Europe exports too little, and Northern Europe exports too much. And I don't know if that's is that an unhealthy thing. Yes, it's unhealthy because their finances are still separated. But in the U.S., the state of Washington exports a lot more, thank Boeing and Microsoft, than the state of fill in the blank. So I don't think there is an export problem, although I do think a lower value of the euro would be helpful, given that Europe is staring into the abyss. It's staring at the prospect of a recession. But another way to frame your question would be, isn't what Europe needs a healthy dose of inflation, one effect of which might be to push the euro down against the dollar? If you think back to that example of Italian debt arithmetic that I gave you before, Italy needs to, in order to stabilize the debt to GDP ratio, Italy needs a growth rate of nominal income, nominal GDP, that's at least as high as the nominal interest rate that it has to pay. So I have been arguing the ECB should step in and deal with that nominal interest rate. Maybe it can do something about the rate of nominal GDP growth by pushing up the inflation rate in what would be a healthy way under present circumstances. So I now get hate mail from Germany because I've said this in some European newspapers. I must therefore be saying the right thing. Yeah?
I don't know enough about this to ask you this question, but I did wonder about the effects of Ireland nationalizing its banks, and if that had any implications on Greece's option.
Well, so the Irish problem is special, as I alluded to very briefly in the course of the presentation. Ireland did not have the same kind of competitiveness problem as the southern European countries because it was able to boost productivity, labor productivity, quite successfully over the course of the last decade. The problem it had was a big housing boom. This will sound familiar, a big housing bubble that burst, that brought down the banks that had lent all the money to households and real estate developers. And then the decision was taken basically for the government to assume responsibility, financial responsibility, for the money that the banks had borrowed. Not only the deposits, but the bonds that they had issued to fund their operations. So that's where the Irish debt crisis comes from. I don't know that it really has first-order implications for what happened in Greece, where the nature of the crisis was different. Not a private sector housing bubble like in Ireland, but a public sector spending binge. I think more the causality went the other way, that when things really went south in Greece, and finally this year there was a recognition that Greek debt would have to be restructured. People who held those Greek bonds would only get 50 cents on the euro, or maybe less. People began to wonder about these Irish bonds again. So the issue of whether those bonds are going to be paid off in full or not is back in the public debate in Ireland. Why should the Irish taxpayer have to pay people who lent money recklessly to Irish banks, where Greek taxpayers don't have to repay money to people who lent the Greek government money so recklessly? So I think the fact that there is now going to be these write-downs of Greek debt is unavoidable. It's part of ultimately resolving the Greek crisis, but it's been another factor that's unsettled conditions Europe-wide recently. Nobody knows which government bonds are going to be written down now and which ones are safe, and that applies to the bank bonds guaranteed by the government in Ireland. Gentleman in the blue shirt.
Yes, I was wondering to what extent the derivatives market problematizes all of this. Yeah, MF Global went down based on betting on the euro, and Morgan Stanley has a huge derivatives holdings. Other U.S. banks have derivatives on the euro. And I was wondering if this could lead to a global contagion, it traveling over the Atlantic to the United States.
So the question was about contagion from Europe to the United States. If the failure of a small to medium-sized financial institution in 2008 called Lehman Brothers in the United States could infect Europe, could transfer across the Atlantic, why couldn't the same thing now operate in reverse? And I think the answer is it could operate in reverse, and that's precisely what happened to MF Global. I don't think you have to go to derivatives. MF Global borrowed a lot of money in order to buy Italian and Spanish bonds in the expectation that everything would be worked out by now, and the prices of those bonds would have already gone up, and they got hammered. There were some other problems there we're learning about now as well, but that's the relevant portion. So in terms of thinking about contagion, I guess I would distinguish two scenarios. One is Greece goes down, which is happening. They're going to write that debt down very severely, but the problems of Greece have been knowledge to everybody for going on 2 years now, and banks have been able to get out of the way of those problems. I don't think MF Global or any other U.S. financial institution at this late stage has significant positions in Greek bonds. But then there's Italy and Spain and France, who was it? It was Moody's this time that hit the wrong button and issued the downgrade warning, or issued the downgrade of French government debt erroneously at the end of last week. So they're preparing it. We know if it's the big countries and not only Greece, there's no way that U.S. financial institutions are going to be able to stay out of the way.
So on that question, to what extent would European crisis affect Asian economies and the economies of Asian states? To what extent is there a role for Asian states to play in the future? We're talking about
yeah, so the question is how much of this story also applies to Asia? I think probably Asia would be dragged down as well by an even more severe crisis in Europe. You know, dragged down is a relative term, of course. The Chinese growth rate would fall from its current 9%. So by how much, no one knows, but Asia would be hit as well. I think the relative importance of different channels would be different, that the financial channel, the financial contagion would be less because Asian banks do less business in Europe. American banks do more business in Europe. But Asian countries rely on Europe for their merchandise exports. Europe is their single largest market, so that's the channel through which they would be hit. Do they have an interest in helping to avert the worst? And the answer is yes, if they can figure out a way to do it. So last month's, or I guess it was still this month's earlier proposal, was that the Chinese government, the Chinese Sovereign Wealth Fund, along with those of India and Brazil and Russia, Goldman Sachs lumped these countries together, and now they're paying the price, that these countries should lend money to the European Financial Stability Facility so it could lend money to the troubled governments. And the government of China rightly said, the phrase they used was, I forget which official said it is, "We are not stupid money." So they want to see the relevant reforms, just like the European Central Bank, before they do anything. And if the relevant reforms occur, it's not clear that they have to take any special action. The other player here that we haven't talked about is the International Monetary Fund. So another possible way in which Spain and Italy could be helped is by proper IMF programs. Spain is already being helped to an extent in that fashion. But the idea is that the IMF is in the business of negotiating a contract with troubled countries. The countries sign a letter of intent about what they commit to do, and if they do it on a quarterly basis, they get a concessionary loan from the IMF. Problem being, the IMF doesn't have enough money to deal with a big country like Italy, much less Italy, Spain, France, Belgium, name your favorite troubled European economy. So that's somewhere where China and India and Brazil could presumably help. They could put some money in a trust fund that the IMF would administer and loan to these countries subject to conditions. Countries don't default on their loans to the IMF if they can help it, because they're defaulting on their loans to the shareholders of the IMF, which mean people like the U.S. government. So that might be a relatively safe way for the Asians to help.
We're going to have to bring it to a close. How about one last question? The person right in the back has been very patient.
First would be, why did the European Union design their package, their bailout package, so that the credit default swap would be triggered when they knew that that was going to cause widespread selling of the debt instruments, knowing that you're not properly hedged, you can't exercise your credit default swaps? And then the second part would be, do you think that the EU is going to be able to leverage their bailout fund, given that they don't have enough right now to cover the debt? And who's going to be the ultimate?
So the second one is easy. No, I don't think they will be able to. And that's why I think nobody wants to put more of their own money into this bailout fund with the high uncertainty that pervades in Europe. The European Central Bank is in a position to do so. There are no limits on its ability to put money in the EFSF if the EFSF is given a bank charter. The European Central Bank is in the business of lending to banks, and that's what most of us think a normal central bank should do. It should be a lender of last resort to borrowers in distress. It's more complicated when the borrower is a government rather than a bank that you regulate. You know, you can send in the Fed can send in the bank inspectors, close down the bank, replace its management if it wants to keep it open. So we had this funny episode where the ECB has now almost replaced the management of the country of Italy. But it's problematic, harder to accomplish, and it's not clear you want to put a central bank in that position. So the only way that's going to work is with the ECB lending, I think, to the EFSF. The other question was technical. I hesitate to end on a technical one that I don't know the answer to, but the question was, why was everyone in Europe so intent on having a, quote, voluntary debt exchange where the banks were hit over the head by policymakers until they agreed to new bonds from the Greek government worth only half the value of their own bonds. And because they agreed, because it was voluntary, the insurance contracts on the old bonds, the credit defaults, were not triggered. Why did they go down that route? Despite the fact that ended up destroying the CDS market or its value in Europe. So there are two possible explanations for that. CDS written on Greek debt are very, very small, but European regulators are terrified by them. They thought that triggering those contracts would impose a very high cost on whomever had issued them. BNP Paribas had issued them. I'm repeating a rumor here that you should not repeat as fact. And that institution would have been placed at risk, so therefore we couldn't trigger them. Lots of other people think that those risks are not so concentrated and triggering them wouldn't have been so disastrous. Another explanation would be the banks that had issued them have power. They lobbied to prevent the debt exchange from being done in such a way that would have cost them even more money if they had had to pay out on the credit default swaps that they had issued. But this is something that the answer to which maybe we will learn someday.
Okay, thanks very much.